Welcome to The Explainer. We're diving deep into the venture capital world today. And honestly, it feels like we're living in a tale of two different economies. You've got this absolute gold rush happening in AI, but what about, well, everything else?
So, let's kick things off with a huge question, one that's bugging a lot of investors right now. I mean, billions and billions of dollars get pumped into startups every year. But where is all that money actually going? And more importantly, is any of it coming back?
And to really wrap your head around the scale of this problem, just look at this number from Carta, 0.27. What does that mean? It means for a typical venture fund from back in 2017, for every single dollar an investor put in, they've only seen 27 cents come back out. And we're talking about real money here, cold, hard cash, not just some on-paper gain. It's a pretty bleak picture, right?
So you're probably asking why? Why are the returns so low? Well, a huge piece of the puzzle is this. Companies are just staying private for way longer than they used to. This data from PitchBook shows it plain as day. Back in 2016, it took less than 5 years for a startup to exit, get acquired or go public. Now, we're looking at over 6 years. That long wait, it just freezes up capital and delays those returns for investors.
All right, so here's how we're going to break this all down. First, we'll tackle what's called the venture capital logjam. Then, we'll look at AI, which is kind of the massive exception to the rule. After that, we'll dive into what's happening in healthcare and the new industrial revolution, and we'll wrap up by looking at how you navigate all the risks involved.
Okay, first things first, let's talk about this venture capital logjam. You can really think of it as a system-wide pressure cooker. And it's squeezing everyone, from the startup founders to the VCs and all the way to their investors.
Now, to really get what's going on, you got to speak the language of VC. So let's quickly break down these key terms. Think of DPI as the cash in your pocket. It's the actual money returned to you. TVPI, on the other hand, is the total value. It's the cash you got back plus the theoretical value of the shares you still hold. It's your paper wealth. And IRR? That's all about speed, how fast your investment is growing year over year. The big headache right now for investors is that they see these huge TVPI numbers, this massive paper wealth. But the DPI, the actual cash, is just trickling in.
And you can literally see that pressure cooker heating up right here in this chart. We're looking at the rise of down rounds. That's when a startup has to raise new money at a lower valuation than their last round. Ouch. This data from PitchBook and Wilson Sonsini shows that just a few years ago, this was pretty rare. Now, more than a quarter of all funding rounds are down. That is a massive, flashing warning light that the system is under some serious stress.
And this is where the legendary investor Bill Gurley just nails it. He said, "The gift of staying private has turned into a curse." What he means is that all this freedom startups have by avoiding the public markets has backfired. Without that public scrutiny, nobody really knows what these companies are worth, and you get what he calls a system-wide coordination problem. Basically, everyone's pretending everything's fine, even when it might not be.
But this gloom and doom story isn't the whole story. Amidst all this pressure and stress, there is one sector that's not just surviving, it's absolutely exploding. It's operating in a totally different universe. And you've probably guessed it, we're talking about AI.
And this is what we mean by the two-track economy. It's like two separate worlds. On one track, you have AI and machine learning. It's a total frenzy. Sky-high valuations, huge funding rounds, investors falling over themselves to get in. Then you have the other track, for basically everyone else. And over there, it's a completely different game. It's all about subdued valuations, smaller deals, and just trying to make your cash last as long as humanly possible. Just how big is this divide? Well, take a look at this. It's kind of mind-blowing. This PitchBook data shows that in just the first quarter of 2025, AI and machine learning companies basically hoovered up more than 71% of every single dollar invested by VCs. 71%. That leaves less than 30% for every other industry combined. Think about that.
So, that raises a pretty critical question, doesn't it? If AI is sucking up all the oxygen in the room, what happens to everything else? What about all the other vital, world-changing sectors out there? And for an investor, where do you even look for opportunities beyond all the AI hype?
Okay, let's pivot and look at one of those sectors. Let's talk about healthcare and biopharma.
I mean, a field that literally saves lives. This is hard tech in the truest sense. We're not talking about code in the cloud here. We're talking about real-world molecules, labs, clinical trials, the incredibly complex and messy world of human biology.
And what's happening here is really interesting. According to HSBC, investment in biopharma actually jumped by 33% in 2024. But here's the catch. It wasn't because everyone was investing more. No, this surge was driven by a handful of huge mega deals. You had big groups of investors all piling into the same companies. It's kind of like a safety in numbers strategy for making these really high-stakes bets.
So where is all that money going? Well, these big bets are flowing into some of the toughest, most important fights in medicine. We're talking about developing brand new platform technologies that can speed up how we discover drugs. We're talking about oncology, the fight against cancer. And we're talking about funding new treatments for things like metabolic and autoimmune diseases that affect millions of people.
Okay, but here comes the harsh reality check. Remember that exit logjam we started with? It's hitting the biopharma world like a ton of bricks. Just look at this number from HSBC. For biopharma companies that managed to go public in 2024, their median stock performance 1 year later was down a staggering 73%. And that number right there explains everything about those mega deals. Investors are banding together because they know they need a massive war chest to survive that kind of brutal post-IPO market.
All right, let's switch gears to another critical hard tech space: advanced manufacturing and climate tech. You know, the companies that actually build stuff. We're talking about the physical backbone of our modern world. In fact, they're the ones building the hardware that the entire AI revolution itself depends on.
And what's fascinating in the PitchBook data here is that valuations for these manufacturing startups are climbing steadily, especially for the more mature late-stage companies. Now, it's not the kind of explosive vertical growth you see with an AI company, but it shows something really important: a growing respect and a growing wallet for companies that can make real, tangible things at scale.
And according to experts at Wilson Sonsini, the investment here isn't just about building a better factory. It's about solving some of the biggest problems we face. For example, all that AI we talked about, it needs a mind-boggling amount of energy. So who's going to solve that? How do we build a tougher, more resilient power grid? How do we bring manufacturing back on shore and secure our supply chains? The companies with real hardware answers to these massive questions, that's where the serious money is flowing.
So let's be clear. Investing in these massive, world-changing hard tech sectors, it's not easy. It is absolutely not for the faint of heart. The rewards can be astronomical, but so are the risks. So the billion-dollar question is, how do you sort the winners from the losers? How do you know if you're backing a true game changer or just a cool science project that's never going to make a dime? But luckily, you don't have to just guess. There are frameworks to help. This one, from Ron Weissman's research for the Angel Capital Association, is fantastic. It breaks down all the startup risk into 8 buckets. This is like a checklist for due diligence. It forces you to look past the slick marketing and the flashy pitch deck and ask the really tough questions about everything from the tech to the team to whether they can actually run a business.
And if you look at that list and think, number 7, governance, sounds a little boring, let me tell you a quick story. This is the cautionary tale of Headspin. It was a celebrated unicorn valued at over $1 billion. The problem? The CEO was allegedly just making up revenue numbers. He claimed nearly $100 million when the real number was closer to 26. And how did this happen? There was no real board oversight to keep him in check. When the fraud came out, the value just cratered. It's a brutal reminder that governance isn't some boring administrative task. It's the guardrail that keeps the whole thing from flying off a cliff.
So that brings us to some classic red flags to watch out for, also from that Weissman course. If you ever hear a founder say, "Oh, we have no competition," run. Or if you ask a CEO about their key business metrics and they get all vague, that's another huge red flag. Look, what's important here is that knowing these warning signs empowers you. It helps you see past the hype and spot the rot before it's too late. Which really brings us to the final, fundamental question we'll leave you with. In this two-track world, where there's only so much capital to go around, what do we choose to fund? Do we put our money behind the next viral app or the next vaccine factory? The choices investors are making right now, today, whether to chase the AI hype
or to make the harder, longer-term bets on foundational technologies in health and industry? Those choices are going to shape the world that all of us live in tomorrow.